One way that professional investors like to measure the volatility in markets is actually not with the VIX, but with the average true range. And so when I look at the average true range of the S&P 500, for example, right now, which is depicted at the bottom pane here in this red line, you can kind of see that if we look back to the past few years, we have found sort of an equilibrium of average true range or of volatility around that blue line where we're at right now, meaning we've had smaller or tighter trading ranges or lower volatility, but we've also had a lot higher volatility. Now, if we take that aside for a minute and we look at the big move that the S&P 500 has had once again over the past 12 months, in fact, over the past 12 months, if I have this chart here, you will see that the S&P 500 is up something like another 33% or so year over year right there. And I sort of juxtapose that to previous historical periods which had an equally sort of stubbornly bullish run, and I mean this in a good way. It is ultimately more a question of time until we start to see volatility as measured by the average true range to increase. And the average true range, all it really does is tell us how much is the average daily movement of any given stock, in this case the S&P 500. If I look at this and I start to look a bit deeper underneath the surface, we're actually already seeing the average true range pick up quite a bit. And one way that I like to take advantage of these opportunities is by looking for extremities of moves, extreme overbought and extreme oversold situations. And we like to use our Vertical X Pro indicator for that. So here, for example, you can see Juniper Networks. This is a stock that had a very, very sharp, 10% drop over the course of a couple of weeks, and then we got very, very oversold. And we ended up getting a buy signal on the 20th of November, and sure enough, the stock started to bounce. Or even something like Target, which got very oversold on a very near-term basis, and then started to bounce. And so these are what we call mean reversion moves, and they are extremely friendly to environments that become a bit more volatile. So I look towards 2025 with an eye towards higher volatility. Again, I'm not calling for stock market crashes. I continue to reiterate that is a low probability call. That can always happen. But the base case for me is more higher volatility. And when we see higher volatility, we're going to see a lot more stocks get extremely overbought and oversold very quickly, which then gives us the opportunity for these kind of mean reversion trades that last from a few days to maybe 1 to 2 weeks. If you'd like to learn more about that strategy, average true range, how we can take advantage of these extreme oversold and overbought situations, which is actually something that a lot of algorithms do, please join us this week in a special session on that. Bring a pen and a piece of paper, and we'll see you there.